Markets flattened out completely.
As we wind down the show, the market has gone a bit sticky, coming off now for the Nifty, so just holding at above that 5100 level. Here is Neem Kumar of Iifl talking about where he sees the market headed for the rest of this year. Iifl kicks off their big investor conference in New York today, and there will be plenty by way of institutional interest over there. Here's what he has to say.
I would think that we are at a point in time where a lot of negatives are known, but how this will unravel and when this will unravel is a bit of an unknown. I would therefore think that investors would probably look for I would say investment themes, stock ideas, and India still offers a lot of them, and so that would remain the focus. So I don't think we can wish away the risks that are lurking, and but it's difficult, very, very difficult to take a call as to how and when it will unravel.
Because of the events that people have lived through over the last few years, the fear right now is that there will be a cataclysmic event similar to what markets lived through in 2008. And in that sense, even India will not remain untouched from the damage. Is it your sense that things could get to that kind of head globally? And would India be an outperformer in that regard? Or do you think we will fall perhaps the most because of how brittle this market has been through this year?
I think, it's always, there is always a possibility of a catastrophic event happening. It cannot be ruled out, but quite unlike, I think, 2008, a lot of negatives are now reasonably well known. There are even discussions going on of a country going down under, what would be the impact. To that extent, I would say debate and analysis have happened. So the second thing is that the liquidity situation is very different, but liquidity can dry up also very soon, but as we have seen very recently in Europe, but I would think that overall liquidity situation is much better at this point in time. The leverage in the system is much lower, particularly on the hedge fund side. So I would therefore think that if a catastrophe were to happen, would it be fair to assume that India would correct? I think the answer is yes. But would it go down the way it went last time around? I don't think so. I think that a number of large caps post the correction that we have seen in the last 12 months or so have already are trading at levels which are reasonably attractive. We have seen earnings downgrades happen, and as you would know that we started the year with a very negative bias, and we've at Iifl we were very worried about a few factors. Some of them have played out. So I would therefore think that a number of large cap stocks would see support, particularly if it were to correct even from here. Even at these levels we are seeing some support. So my guess is that probably the downside would not be as severe. Of course, instantaneously when emotions kick in, you could see a bit of a correction, but I would think that incrementally the downside from here on is actually limited in my view.
I'll just get to that point you were making about the market performance and returns, Neem Kumar. But before that, what's the sense you're getting on the liquidity front? Because money has been scarce this time round, both in terms of inflows and outflows, as we were discussing. But it seems to have taken on a more momentum-based nature rather than value picking. It's bought when the market has cracked down to the 4,700 level, and then not really committed too much capital beyond this 5,000 mark.
I think a lot of that is related to the futures and options volumes. In my view, what I get a sense from the large long-only investors in India is that they are looking for stock-specific ideas, and of course at a particular valuation which they think is good enough for them, good enough on a risk-reward basis. So therefore my guess is that flows are still I would say very stock-specific. these are not times when you see macro flows where 2006, 2007 were periods in time when very large amount of flows came from macro funds. That's not the case at this point in time. So the volatility that we are seeing is entirely led by, I would say, either shorting or people covering their shorts based on their near-term view on what's happening in the global markets. I wouldn't read probably too much into that with it being momentum driven and long only kind of driven at this point in time. I would rather probably believe that long only guys would probably come in on a stock specific basis, and to that extent you could see some bit of market volatility.
This year, expecting it to be a year of negative returns for our market, Name Kumar, and up until now we still remain one of the biggest underperformers on the global equity space. What is your view of how things may shape up in the tail end? Because over there is some debate on whether markets may generally potter about in a range and finish off this year, or whether the tail end will actually see quite a bit by way of price damage.
I would think that the markets would probably move in a narrow range in and around the current levels, maybe with 4,800 as the bottom. That's my intuitive sense at this point in time, and the reason why I believe so is that the valuations of quite a few large caps which have large weightage in the index have fallen to levels where fallen to historical troughs, and therefore for the stocks to decisively break those levels, either there has to be a very big panic, something terribly going wrong, or something specific happening to those particular stocks or industries. So I would say I would assign a very high probability of the market trading in and around probably the 4,800 to 5,200 kind of range, and it would probably decisively break out either way. Only we see a few more things changing both at the global level as well as in India.
So at this point, how much probability would you attach to the possibility of the market breaking all the way down to 4,300, Name Kumar?
Probably 20%.
I just want to focus on the earnings for a little bit, where as well there is quite a bit of doubt. I was just going through your note where you were talking about earnings deceleration, and some of your peers had suggested this may end up to be a year of single-digit earnings growth. Is that likely to your mind?
Possible if asset quality issues in banks emerge. It is very likely. Now see, Mitali, the earnings downgrades have been happening for the last 7-8 months. From the peak, I think index earnings have already seen 6 to 7% kind of downgrade. And we could see upgrades in some sectors like software. We recently turned bullish on cement. So we could see upgrades there. Investment cyclicals which are passing through a period of pain. Already we have seen very big downgrades in the last 6-9 months. So the only unknown at this point in time is banks, and if we see real pressure building on the asset quality side, which will be visible only probably in January or February, I think that we could see some further downgrades in earnings. But my guess is that a large part of the downgrade has already happened. Whether earnings growth for this year is going to be in single digits, I don't think so at this point in time.
How do you mention IT as well, Name Kumar, as a space that you're turning positive on, and that's been bludgeoned this year? How would you approach that space? Is it a valuation call, or do you think the market is overdoing the fears in terms of how much volumes may contract?
I think if you go back into the history, every time when worries of global slowdown creeps in, you see the IT stocks taking a pounding, and this time also it's been no different. I think at these valuations, a lot of that is priced in. In our view, there could be actually positive surprises there, and relative to expectations, not so much the consensus earnings per se, but just the worries that investors have. If 2 quarters down the road, if they're proven wrong, these stocks can quickly spring back. I would think that they offer good value at these levels.
What's taken people by surprise is the startlingly bipolar nature of this market, Name Kumar, where defensives have been trading at bull market valuations while the rest of the market has been completely compressed. On that particular pocket, where do you stand? The faces like FMCG, like pharmaceuticals, even two-wheelers amongst the autos.
I still think that the consumption momentum in the economy will hold up. It's not going to decelerate. We have been negative on the investment cycle for almost 1.5 years now. Now, as we speak, I'm still not confident whether we are likely to see a revival immediately. And while on the consumption side, the rural economy is still holding up reasonably well. So I think that a barbell strategy would be a better approach in this market, where you still hold on to defensives where growth visibility is high, not as much as you would have at the beginning of the year. If you look at our notes when we put out in January, we had an absolutely defensive strategy at that point in time. But I think at this, after the correction that we have seen in some of the deep cyclicals, I think it's a strategy where one should have a strategy of owning defensives as well as, I would say, some of the oversold deep cyclicals.